Now for business news again, we check in for another update with Mike Eppel over in the 680 newsroom. Good morning, Mike.
Morning, Tammy. We're watching the bond market today for bets in the bond and currency trade that the Bank of Canada might not be one and done raising interest rates this year. Of course, the central bank hiked rates for the first time in about 7 years back on July 12th, and we've been tracking bond yields, which are sort of a predictive force within the market for, well, what people think will happen with interest rates going forward. And yesterday we saw the benchmark Canada 10-year bond yield top 2% for the first time in close to 3 years. And it's getting very close to the U.S. counterpart, the U.S. government 10-year Treasury. So this is the market signaling that come September or October, we should be ready for the Bank of Canada to raise interest rates another 1/4%. It all follows the better performance and forecast for the Canadian economy. This week we will be getting some economic statistics as well, so keep an eye on that. But Canada's on a bit of a roll here. Maybe the U.S. is slowing down just a little bit, so this is part of the reason why the Canadian dollar has done as well as it has over the past little while. For the first 2 trading days this week, the dollar has breached 80 cents U.S., only to slip back a little bit by the close of trade. This morning we're starting the trading session with the Canadian dollar again testing 80 cents, $1.25 on the exchange rate if you are buying U.S. greenbacks. Maybe the market, though, might be running out of a little bit of steam there for the loonies advance. Consider the fact that yesterday the price for oil was up 4% in the U.S. and 6% on Canadian oil quotes. So the Canadian dollar typically moves in lockstep with the price for oil. Not so much right now, however. And we'll also track that price for oil up as much as it is for any changes later this week to gas prices here in the GTA.